Welcome to Inside Economics. I'm Mark Zandi, the chief economist of Moody's Analytics, and I'm joined by my two trusty co-hosts, Chris Derides and Marissa Di Natale. Hi, guys.
Mark?
Hi, Mark.
This feels like a daily event, this
It is.
podcast thing. What's going on?
We were just on yesterday.
Yeah, that was a good one, wasn't it?
That was a great one. Yeah.
We had John Carney of Breitbart on. Boy, the Trump whisperer. It was actually quite interesting.
Absolutely.
Yeah. Would you agree?
Yeah,
we didn't have
we
we didn't have chance to. We typically do the podcast. The guest leaves because we have to come up with a title, which is very painful process to come up with. It's the most painful thing we do for this podcast, and we don't want to put the guest through that torture. And then we kind of talk about the podcast a little bit, and we didn't have a chance yesterday. I had to run off. So, what'd you think? I thought it was. I really thought it was pretty interesting, pretty cool conversation. No,
It was. I think it was too short. We need a part two. Yeah.
Really?
Yeah.
There's a lot more to unpack.
Oh, we're gonna have him back though. We're gonna have part two.
Yeah.
That's what we need.
Part two. Yeah,
It
because
was it was good to get that perspective. We don't often get that perspective, so it was really good to hear it.
You mean kind of the conservative?
Yes.
From the Trump administration.
Yeah.
Yeah, and he did a good job at explaining it. So good. Oh yeah, I thought it was a wonderful conversation and good, and it was also good timing, right? Because we had Robert Reich, the former labor secretary under Clinton, who's a very strong liberal progressive voice, I should say, and on before, and he was great too. I thought he was fantastic. So
Yeah.
Yes, absolutely.
yeah, two good podcasts. A lot going on in the economic front, but before we kind of dive in here, let me bring in our guest, Adam Ozimek. Adam, how are you?
I'm great, Mark. Always glad to be here. See you guys again.
Yeah, and Adam is the chief economist at the Economic Innovation. I got that right. Economic Innovation Group, right? Yeah, EIG.
Right.
I keep saying EIG. But the real claim to fame in my eyes is we used to work together. You were at Moody's for a number. How long were you at Moody's?
5 years.
5 years. Yeah, we did some really good work. Some classics.
Great stuff. Very proud of a lot of the stuff we did there.
Yeah, on productivity, growth, and aging. I remember that one. You did a lot.
Still underappreciated, very underappreciated paper, I think.
Totally underappreciated. Yeah, maybe we should try to update that. Get the data and try to update and re-release and take another crack at it.
We used ADP data at the time.
Right. Yeah, maybe I'll knock on Neela Richardson's door and ask her if she'd be willing to fork over that data.
You should.
Yeah.
We should try to publish it this time because that's the only way that
I agree.
things get seen by economists, apparently.
I agree. And how long have you been at EIG?
3 years.
3 years.
Yeah.
And a lot of good work there. And we're going to dive into that because you did a study on immigration and immigration policy. And obviously that's top of mind in the context of current economic policy being made in Washington. And I thought it was great paper. I will admit it was a lengthy paper, so I did use Notebook LM to help out. And not to plug another podcast, but that damn Notebook LM has they turned it into pretty good podcasts.
Can't argue with that.
Yeah, and pretty compelling. I guess they're bots speaking. I don't know.
Oh, this is the podcast where it's all AI generated that you're
talking about. AI generated.
Okay, I haven't listened to it yet, but I've heard about it.
The one thing do you use Notebook LM, Adam? Do you use it?
I have before. I don't use it regularly.
You don't use it regularly. Those one thing I wonder about is I do generate a podcast when every time I use it. And sometimes the podcasts are like 10 minutes. Yours was 30 minutes. I think that's the longest podcast generated so far, at least in my limited experience. And I don't know if there's any correlation between what the AI values and the length of the podcast, or why is 110 130? I don't know. Anyway.
Let's assume it's correlated with quality. That's
quality
must be.
Yeah, absolutely. And I just to point out, you're also you go all the way back to the first, I think was the first guest we had on this podcast back nearly 4 years ago. You were the first we had. And as I recall, at that time, the burning issue was remote work. And you had been doing a lot of good work on trying to understand the consequences, the economic consequences of remote work. And you were correct me if I'm wrong, this is 4 years ago, but you were a strong proponent of remote work, thinking that it would help to enhance labor productivity. Do you, what here 4 years later, a lot has transpired. The sentiment around remote work has kind of shifted back to you got to be in the office kind of thing. What's your sense of things now? If you've been following it, what do you think have your views shifted in any way?
Yeah, I mean, it's important not to confuse the data for the vibes on this one because,
Yeah.
the CPS now measures it every month. They measure remote work. It's part of the household survey, and it hasn't gone down over the last few years. If anything, it's moving up. You've got full-time around remote work is around 11%, and hybrid remote work is around 12%. And those have moved up maybe a percentage point or so each over the last 2 years. So like
Hmm.
there's no sign of this mass return to office in the best data that we have. And I think those are pretty substantial numbers. You hear I was on a panel a year or two ago about place-based economic stuff. And then all day everyone's talking manufacturing this, manufacturing that, manufacturing this, manufacturing that. And then one of the panelists was like, remote work, it's really a marginal thing. It doesn't really affect that many workers. I had to tell everybody there are as many full-time remote workers as there are manufacturing workers in this country at this point. So like this is not a marginal phenomenon. It is a major economic phenomenon. And then that doesn't even include the hybrid, which are, another 10 to 12% on top of that. So it doesn't seem to be going anywhere. And I think that speaks to the productivity effects and the amenity value that workers place on it.
Yeah. So 11% of the workforce, this is from the current population survey, the household survey, is fully remote work. And that I think that's higher than the share of jobs that are in manufacturing, I think, at this point. Or maybe it's
I think
close.
it's pretty close. Yeah,
We're
I
pretty
think it's
close.
about
Yeah.
10% manufacturing.
Have you seen any good recent research trying to measure the productivity impacts? I mean, I've seen studies on both sides of this. It's lifting growth, it's restraining growth, had no impact. Is there kind of a meta? Do you have a meta perspective on the productivity impacts?
I do. So almost every time that you dig into one of these negative productivity result papers, what you find is a pre-existing sort of firm market failure, right? You have a pre-existing problem. So Emma Harrington, Natalie Emanuel, great economists, had this great study looking at um, a company that had a bunch of office buildings and workers scattered throughout the office buildings. And some people worked alongside their teams pre-pandemic, and some people worked in different buildings pre-pandemic. And so the pandemic happens, everyone goes remote, and now you have this exogenous source of relative increase in remoteness, right? And so it's a great study. It's really well identified. And they found a decline in productivity, but the reason that they found a decline in productivity was because when you put a senior worker and a junior worker near each other pre-pandemic, the senior worker would help the junior worker improve. Okay. And post-pandemic, that doesn't happen. And they investigated at the firm, why doesn't it happen? And there's this for the senior worker, it actually would hold back their productivity pre-pandemic to help the junior worker. So after the pandemic, they go remote. The senior workers get a little bit better. The junior workers get a little bit worse. The net impact is negative. But like, what does that tell you about the firm? The senior workers have no incentive at the firm to mentor. It's just
Right.
that so happens when you place people next to each other, they do that sort of mentoring informally.
Just to be
And so
nice.
just to be
Yeah.
nice. And so
Yeah.
like I see this and I say,
I do
okay,
that all the time with these guys, Adam.
great
Remotely.
productivity.
Remotely.
And successfully.
But like this
No,
that's a firm
actually I don't.
failure.
They're on their own totally. They're totally on their own. Yeah.
No spillovers.
No spillovers.
But like that's a firm failure, right? Pre-pandemic. You had these people doing something that was literally so important to their jobs, it was holding back their own productivity. It was costing them, and they see these people, their pay goes up afterwards because the senior people, they're working harder, their pay goes up. Like so it's pretty substantial impacts. And it's a managerial failure that should have been fixed beforehand. And so I think you're observing these kind of stresses and tenses where things that are really imperfect become stressed by remote work. And in the long run, these are things we'll figure out, right? Like, okay, we need a more explicit compensation for managers to be mentoring. It should be part of their, like, quarterly reviews. We should keep track of it. You see similar things with knowledge spillovers as well. In office, a lot of knowledge spillovers are sort of occur like informally. Oh, you need to know this, go talk to that person. Oh, go see this person. I think they were here for that project. I don't remember who was here then. Go talk to this person. They've been at the company. That's so crazy informal, right? Like, that shouldn't be the case. And so I think that firms are going to adapt their management practices to be more formalized in terms of these sort of spillovers. And that is going to be productivity enhancing when they actually do the work to do it. Like, it shouldn't be the case that, like, you need to walk around the office tapping on people's shoulders to find out who worked on a project and what did they know about it, right? Like, we should be like formalizing this information sharing.
Yeah, totally. That makes total sense to me. And I can see it in our own business. I mean, we now uh, ex intentionally design research projects so that we allow for senior people to work with junior people across the globe. And obviously you couldn't do that in person. There's just no way someone sitting in Pennsylvania is going to be able to work with someone in Prague or in Sydney or in Singapore, but we can do that remotely. And that way, I think it improves the product that we're producing, the research that we're trying to achieve, the research results we're trying to achieve, but also accomplishes that mentoring aspect of what needs to be done to make sure that the future is also sound. That it's not only about today's productivity, it's about future productivity growth. But I think you're absolutely right. We're all adapting. We have to adapt to this. Adapt to it. But
Yeah.
we didn't ask you to come on and talk remote work, although we certainly could talk about it. But I do want to go back to immigration. But before we do, you're also a great economist, and there's a lot going on in the economy, and we got a lot of data this week. And Marissa, I'm going to put you on the spot. Anything you want to call out in the data? I mean, we got we got GDP, we got initial claims for unemployment insurance, we got consumption spending, PCE deflator, consumer expenditure, home sales. It was a big week and the big story behind it, I think. But let me turn it over to you. You want to give us a rundown?
Yeah, there's a lot every day. This morning, we got spending data. Real spending fell 0.5% month over month, which is consumer spending, right? Which was quite a large decline. The same time, we got personal income, nominal personal income, which rose almost a full percentage point over the month. So we have strong income data, but decline in spending. Nominal spending fell. So it's not just an inflation effect. Nominal spending fell and we got stronger inflation over the month. The PCE deflator came out, as you said. This is the Fed's preferred measure of inflation. That was in line with what we were expecting, given what we saw already on CPI and PPI. So that rose 0.3 percentage points over the month, 0.3% over the month. Same with core, same measure with core, 0.3. The year over year ticked a little bit lower because of the base effect from the comparison of last year. So we're looking at 2.5% year over year now on PCE growth and 2.6 on core PCE. So still 0.5 percentage point above where the Fed wants to see it. We got the second read on fourth quarter GDP. There wasn't a revision to that. So that GDP figure holds from where it was previously reported. So that's 2.3% annualized in the fourth quarter. Just a couple other things that sort of interested me. Jobless claims came out yesterday on Thursday. This is something we're watching because, of course, all the layoffs at the federal government, perhaps, right? Some of this is tied up in court now, so it's kind of a little bit difficult to get a gauge on how many people are actually losing jobs, but jobless claims did rise. They rose by 22,000 over the week, but none of that really looks like it's related to DOGE or federal layoffs. That looks like all to be in the private sector and states where it wouldn't be intuitive that you'd see things directly tied to the federal government. Claims are still low at 242,000 a week, nothing to worry about yet, but it was a bigger pop than we've seen in claims week over week. I don't make too much of that yet. That said, I won't be surprised to see this rising, as we move through the next few months. And then I guess we got a lot of housing data too. So we got some measures on house prices. We got new home sales, mortgage applications, pending home sales, all other than prices, all very weak, right? So price growth is still looking like somewhere in the realm of 4.5% nationally, however you measure it year over year, but home sales fell, pending home sales fell, mortgage applications fell. So housing market looking really weak in terms of just, sales transactions. Yeah.
Okay, so
Did I miss anything else?
Um,
Oh, did we talk about the conference board yet?
no, we did
Yeah.
not.
That happened when, or earlier this week, I guess.
Tuesday.
And Mark, you sent a email pointing this out to some of us. You were very worried by this. So the conference board.
A little flare went off with that report in my mind.
Yeah, the survey of the conference board's survey of consumer sentiment
confidence
fell quite a bit. It is quite low. I mean, it's like now it's kind of post-pandemic low again. And this was a, month over month, pretty sharp decline. So the overall index went from 105 to 98 over the month. And most of it was expectations about the future, like over the course of the next year. And there's also, this, just like University of Michigan Conference Board asks about inflation expectations, what consumers expect the rate of inflation to be a year from now. That jumped from 5.2% to 6% over the month from January to February. So
I didn't catch the in that report. I often look at the so-called labor, I guess it's labor market differential, jobs easy versus hard to get. Did you look at that?
I did. I mean, that actually narrowed a bit. So on the jobs front, there wasn't
any.
People thinking jobs are plentiful kind of stayed the same. People thinking jobs are hard to get rose a tiny bit. But if you look at the last few months, it's not out of range where it's been in the last 4 months. So people don't seem to be that worried specifically about the labor market. It seems to be more inflation-based worries going forward.
Okay, so blizzard of stuff, add it all up. What's it say about the economy in early 2025?
I mean, I think it looks shakier, but I don't think, the hard data is still okay. It's more sort of this soft, Adam, as you call it, vibe data, stuff from consumer confidence surveys, inflation expectations.
Right.
Looking at the stock and the bond markets have looked a bit shaky over the course of the last week, but the hard economic data, I just don't think we've had enough of it yet to fully reflect some of this softer data. I mean, I think the labor market, just given what's going on with Doge, right? I certainly expect softening there, and I'm not going to be surprised to see UI claims keep rising. But consumers still look okay. I mean, the consumer spending data was bad, but that could be seasonal. That could be a one-off kind of thing. Income still looks strong. So I'm not super concerned about that 1 month of bad data.
Well, at the very end of this podcast, I'm going to come back around and ask for your probability of recession.
Yeah.
We haven't done that in a while, just to sum it all up. But Adam, you heard Marissa's kind of take on the data. Anything you want to flesh out or highlight or call out? And I'm, most obviously interested in your broader take on what's going on here as we make our way into early 2025.
I think what we're seeing really is just the delayed effect of we've got interest rates are above the neutral rate. That's my belief. I believe we're still above the neutral rate. And if you think that that's true, none of this is mysterious, right? Job growth just gradually decelerating, right? And so the more it decelerates, the more you get these like signs of kind of weakness in the economy, and you start to see early indicators. And I just think, what is it, 4.25 to 4.5 right now?
Yep. The funds rate.
I don't think that's the neutral rate. I don't think we're there yet. I think that it's taking a long time for things to work, for the inflationary pressure that we had to finally work its way through the economy. I think we made the mistake of raising expectations right? Raising people's expectations of inflation. And that's the kind of, toothpaste you can't put back in the tube quickly. So it's taking a little bit longer to wring that out. That plus, it's not like deficit spending has gone back to normal either. So, everyone talks about ARP, but it wasn't just ARP, right? It was ARP, and then it was debt forgiveness, and it was,
You're saying the
debt.
American Rescue Plan, the
Yeah.
COVID relief plan. Yeah.
Yeah, there's a tendency to look at like the fiscal stimulus as being
Yeah.
something that happened in March of 2021, and since then, well, how can we still be talking about it? But it's like it wasn't just that. I mean, there was a lot of student debt forgiveness. There were things like the rent moratorium that put money into people's savings. So, and deficit spending remains higher than it was before the pandemic. And so, when you have that kind of pressure, and you have the inflation expectations pushed up, it's just taking a while for interest rates to sort of push the economy back to normal. And I think that we're mistaking a slow return to normal for a higher neutral rate. And I don't think that's the case. I think the neutral rate's probably higher than it was pre-pandemic, but I don't think we're there yet.
So do you have a sense of so we're at 4.25, 4.5 on the funds rate. That's down 100 basis points, a percentage point from where it was at its peak in late last year. What do you have a sense of what the neutral rate is?
I'm enjoying the liberty of not being involved in economic forecasting anymore.
Yeah.
I don't have to do
Just
that.
curious.
I don't have to do that anymore, but I don't think we're there yet. And
yeah,
I think that a lot of it comes down to productivity growth. And if you think that, I hear people say, well, look, productivity growth is much stronger now than it was before the pandemic, right? And so the neutral rate should be higher. But that only works if people believe that, right? Like productivity growth pushes up the neutral rate because businesses think that their return on investment is going to be larger. Households think their real wage growth is going to be larger, and therefore both spend, right? Businesses spend and invest, households spend and invest. And so that pushes the demand for savings up and the neutral rates higher, right? But if you and I and all the economists in the room say, oh my gosh, productivity's 2%, it's up now. But if people don't believe that, if businesses don't believe that, and households don't believe that, and it's not affecting your expectations, it's not going to affect the neutral rate, right? Not until productivity growth stays up high enough to convince everybody. And so I don't think everybody's convinced yet. So even if productivity growth is higher, I don't think it's really pushing the neutral rate up that much.
And just to reminder for everybody, we've talked about this a lot on the podcast, but the neutral rate is simply put the rate at which interest rate policy is neither supporting or restraining economic growth. And you're saying the current rate is higher than the neutral rate, therefore it's restraining growth. So you're saying growth is slowing, but no big surprise. The interest rates are high relative to where they should be to be neutral, is what you're saying.
That's right. That's right. And I think you can see if you look at the construction sector, does this look like a sector where we're at sort of neutral, right? Like that the current rates are consistent with the kind of long run activity we need there for a healthy economy. Like housing starts are coming way down. Everyone you talk to, maybe this isn't true for you guys, but everyone I talk to in the construction industry is fairly panicked. Construction,
they're panicked about the tariffs, is what they're panicked about.
They weren't happy before that either. I mean,
true.
So I just, it doesn't seem,
and the immigration, aggregate, which we'll come back to, they're worried about that too, because as you know better than I, the industry relies very heavily on immigrant labor. So yeah.
So if you look at the aggregate, I don't believe the neutral rate's as high as it is. And then if you look at kind of more micro stories of like, okay, here are interest rate sensitive industries. Do they look like they're at an equilibrium? I don't see that. They seem like they're dealing with activity. It can't go on like this. It can't sustain. And I think if rates don't come down further, we're going to see more signs of stress in construction and other interest sensitive industries.
For the record, and I don't want to go down this rabbit hole, but just for the record, we estimate the neutral rate to be 3.75%. So we're in the camp. It's above equilibrium, but within spitting distance, I guess I would say. But you're right, Chris. What do you think?
A percentage point above that's still.
Well, it's about I guess about a half a point above. About a half a point above.
Yeah.
Right. We're 4.25. Well, half a point to 3/4 of a point above. Yeah. Chris, what do you think about the economic? What's the economic data say about the economy's performance? And What do you think about this broadly? I've got a view too, obviously. I'll express it after you express yours.
Sure. Yeah. So I echo some of Marissa's sentiments here about just the increased fragility in the economy. That's what I see. Just consumers, businesses, just on edge for a variety of reasons, right? There is the higher for longer interest rate that Adam points out that continues to have a grinding effect, particularly on some subsegments of the economy, as we think about lower income households in particular. But the hard data, if you will, suggests the economy is still performing. The labor market is still delivering. There are some, signs of potential weakness here, but the weakness in spending this month is after a pretty strong December, right? So you have to look through the glass, look through the entirety of the data here. And so right now, the trajectory is still, I would say, fairly solid, but there are definitely lots of potential fissures here, and I think that's that frailty, that fragility is showing up in certainly some of those confidence measures. And if we're not careful, right, then they will show up increasingly in the hard data as well. Spending goes down, investment goes down, unemployment starts to rise. So that's not my forecast just yet, but there's just so many uncertainties here that it is having a chilling effect.
Yeah, my sense is the economy's stepping down pretty meaningfully in terms of growth. I mean, last year, calendar year 24, growth was 2.8%. That's real GDP growth. It was a little over 2% in the fourth quarter. And Marissa, you said it wasn't revised, so it was still kind of, I think it was 2.3%. And just got hot off the presses. We do the tracking estimate for GDP based on all the incoming data. And we got, as we were talking about, a lot of incoming data. You didn't mention the trade data, by the way. The trade data came out.
Oh, yeah, I didn't.
Yeah. Now, that showed a big increase in imports, probably related to tariffs, my guess. So that probably overstates the case. But we're down to 1.2% on Q1 GDP growth. Now, some of it is perhaps tariff related, the pulling forward of imports. Part of it might be, I agree with you, Adam. I think rates are high relative to equilibrium. I think that's playing a role. The timing, though, feels, just for the step down was too big to be simply, a rate that's above equilibrium. That, it kind of felt too non-linear for that to be the case. But anyway, I think that's playing a role. I also think it's got to step down by definition, right? Because last year we got, and the year before, a lot of labor force growth that allowed the economy to grow more quickly without generating inflationary pressures. But now immigration is way off, and again, we're going to come back to that in a minute. And labor force growth must be slowing, and therefore, if we don't get some step down in growth, we got another problem. Inflationary problem. But in my view, my sense is that the big thing that's playing a role here is uncertainty, policy uncertainty. You can see it in all the surveys. You can see it, the NFIB survey. You can see it from corporate earnings when CEOs get up and CFOs get up and talk about their earnings or talking about, economic policy and just trying to figure out what's going on. And it's intuitive. I mean, look at the tariff policy. It's all over the map. It's on again, off again. China, Canada, Mexico. Which products? Which over how long? What period of time? These things are highly uncertain. It's DOGE. It's the kind of the haphazard way about cutting jobs. I mean, it's just. I think it's very disconcerting for not only people that are working in the federal government, but all the private sector folks that cater to the government through goods and services they provide to the government. And just more broadly, I think people are watching this and saying, "Whoa, this is very unnerving." And then I don't know if this is seeping into the collective psyche yet, but it will. We got the potential for a government shutdown in 2 weeks. That feels like a real possibility to me. And then we got the Treasury debt limit coming this summer. That's definitely not playing in anyone's thinking, but that will be playing in everyone's thinking in the not too distant future. We're going to be in the middle of a pretty, I think, knockdown, drag out battle over the Treasury debt limit. So it just and immigration policy, all the things going on with regulatory policy. It just feels like everywhere there's just everything's up in the air, and if that's the case, and even the Fed's saying it. The Fed's saying, look, I'm not going to cut rates any further until I get clarity around economic policy. I'm going to sit on my hands. That's what they said. That's the message I took from the minutes from the last meeting, is that, we don't know how this is all going to play out and what it means for inflation and growth. So we're just going to, sit on our hands for a while. I think increasingly businesses and consumers are doing the same thing. It's not that they're cutting, that would be recession, but they are sitting on their hands, and that's much weaker growth. So I think I worry about that. I mean, that's why I sent off the yellow flare. And the thing that the line between a slowing in growth and recession is simply sentiment, how people feel. People, lose faith, and that goes to the consumer confidence measures that you mentioned, and start packing it in and stop spending. We're done. We're going to get into that self-reinforcing negative cycle. I'll stop there. Adam, I'll turn back to you. Any comments on what I just said?
Yeah, I think it's possible. It seems a little early for me to see uncertainty really moving the economy that much. And I'm always cautious around January to be over-interpreting changes. And so I don't really see the sort of step down in activity. It looks more to me like a, sine wave towards slower growth and slower recovery, especially given, as Marissa pointed out, some of the strong data that we still have. So, but that said, I think everything that you described happening will happen. Like, I think that tariffs and uncertainty are bad for growth. I think it makes the Fed's job so much harder. You hear this excuse that, like, well, tariffs are a price level shock, and the Fed just going to look through that. And it's like that's easy to do when inflation is 2%, and you know where the neutral rate is.
Good
But
point.
when inflation is above 2% and you don't know where the neutral rate is, and the Fed's like playing, very on edge with whether they're going to cut or not, that's like the last time you want a price level shock. Like, they're not they can look through it if they can tell what it is, but there's no guarantee they're going to be able to tell what it is given the huge amount of uncertainty that's going on. So terrible timing for that. I think it does risk delaying rate cuts that we otherwise would have. I think it's bad for investment. So you look at like a measure like the VIX, and I think it's not too surprising we're seeing pullback in the stock market. Like, I think the uncertainty is real. I just don't think it's really affecting most business and consumer investment decisions yet, with the exception of maybe actually driving the imports up as people try to get ahead of the tariff.
Yeah, interesting. And a great point about the Fed and uncertainty. Okay, let's do this because we're here. Let's play the game, the stats game, because that might flesh out some of the data. And then we're going to come back and talk about immigration and the work that you've done there, Adam, and the policy proposals you've put forward. The game is we each put forward a stat. The rest of the group tries to figure that out through clues, deductive reasoning, questioning. The best stat is one that's not so easy, we get it immediately. One that's not so hard, we never get it. And if it's apropos to the topic at hand, and I'm not sure what that is, but so that we can, that gives us a lot to talk about. It feels wide open, it feels wide open. All the better. So Marissa, we always start with you. What's your stat?
My stat is 614.
614. Ooh, is it data that came out this week?
Yeah.
Government data?
Yeah.
New home sales?
Nope.
That would be 614,000. How many new home sales were there?
I think it was like 620,000, or actually, it might be like 6.4. There was a 4 in it, wasn't
I thought there was a 4 in it.
I think there is, and maybe it's like 624.
And you're known to play with the game a little bit, take license with it.
We're bringing that back up, are we?
14 is 614, 614,000. What's the difference? I meant 614,000. No, okay. So
this is 614,000, and it's not housing related.
Not housing related. Okay.
It is something I mentioned in my rundown.
Not in the Conference Board survey. No, there wouldn't be anything there. Would it be in the Conference Board survey? No.
No, and this is a government survey.
Oh yeah, government statistic. Adam, any ideas here?
I'm terrible at this game.
Really?
That can't be true.
Yes.
Okay, I guess we'll just have to play kind of standard game. GDP, is it in the GDP number?
No.
Is it in the
Oh, was it in the unemployment insurance claims?
Yes.
Oh, it is. Okay.
Is that
What would that be? 614.
increase in Washington?
Oh, DC UI claim increase?
No, but close.
Close.
DC, Virginia, and Maryland UI claims.
No.
I don't know. I give up.
It's the number of civilian federal workers filing unemployment insurance claims.
Oh,
They break that out separately.
I didn't know that. I didn't know they break that out.
Mhm.
Always have broken that out separately? Oh,
Yep.
cool. Oh, that's
And
great.
they do veterans too, military veterans separately. So this didn't change, and this hasn't really, I mean, it is up from last year, but it's not, hasn't really changed in the last couple months since Doge has gone in and started doing all this stuff. And I think this is just testament to, again, the uncertainty of some of the status of these people that are being affected, but also the fact that if people are getting pay, if they're getting any kind of severance pay, they cannot file. I mean, they can file, but they're not going to get unemployment insurance benefits, or they're going to get a reduced UI benefit if they're collecting any sort of severance pay or continuation in pay, which my understanding is that most of the people that have been fired or put on administrative leave are being paid, right, at least through September is what we've heard. So I don't necessarily expect the direct effect of Doge layoffs to appear sharply in the data, right, imminently. It could be 6 months before we actually see it, when people's pay stops being given to them in September. But it's worth watching, and it's worth watching just looking at the DC, Maryland, Virginia UI claims in aggregate, because as I think you mentioned, Mark, I mean, this is going to have knock-on effects for private sector contractors. It's going to have eventually secondary effects if, they're talking about unloading a lot of real estate in the district, right? So talk about retail and restaurants and those kinds of things that eventually will be impacted by this.
Interesting. Yeah, that makes sense. So what you're saying is because these folks are getting some form of severance compensation, unlikely they're going to show up in in the claims data, at least for a while, But it will affect, it feels like it might affect private sector workers that cater to the federal government selling goods and services. They might be affected more quickly, so that might show up.
If they're not getting any kind of severance.
I will testify from an anecdotal perspective, because I have a lot of points of contact with the kind of what they call euphemistically call the Beltway bandits. I think that probably, I don't like that term. Like,
You
Adam,
call
are
them
you
the
a
deep
Beltway
state,
bandit?
right?
You a Beltway bandit?
You mean the deep state?
I meant the deep state. Yes, the deep
Yeah.
state. Yeah, they you can feel it. You can feel it talking to them. There are layoffs already occurring among many of those organizations that typically do work for business, have business with the federal government. You can already feel it. Okay, Adam, you want to go next?
You guys are gonna get mine. It's real easy. Reflecting my not being good at this game.
Now that means we'll never get it.
That's right.
I know.
You jinxed it.
80.7.
That sounds like a labor market statistic. No?
Yes.
That's a question. That would be participation. No, that would be.
Like
I know what it is. It's your favorite measure. It's prime age.
That's
I know
right.
Adam so well. It's prime age EPOP, employment
Yep.
development. Yeah.
I thought it'd be apropos to pick my
Apropos.
favorite
It's
measure.
appropriate. It's appropriate. Yeah. You want to explain?
It's the share of people aged 25 to 54 who are employed. It sort of holds aside any sort of difficult measurement questions about whether someone is unemployed or not, whether they're in the labor force or not. It says, let's focus on the prime working years and let's just look at whether they're employed or not. And it's my favorite measure of labor market slack. And I worked hard for several years to convince Mark to become a proponent. And I think I got you right.
Oh, absolutely. It's the stat I look at it every month when the job number comes out. Absolutely. Yeah. And 80.7 would be consistent with full employment, right? Or what would you say it would?
No, I think we can get it above 81. I use
really? Okay.
I use the late 90s, early 2000s as the benchmark. So I think we can get it above 81%.
So
But
you think there's slack in the labor? Oh, this goes to your point about the federal funds rate too being a little too high.
yeah, it's very hard. This kind of this kind of economy where you're trying to wring out inflation, okay?
Yeah.
It's it, there's sort of this paradox where like the labor market is a kind of a source of tightness, but it's still like below where you would consider full capacity. And the example I would give is if you look at the 1980s, okay?
Mm-hmm.
I look at 1980 through like 1995 as one long slack labor market because inflation was marching down, right? It
Mm-hmm.
wasn't like Volcker raised rates and defeated inflation, and then in 1983 we had 2% inflation for the next 2 decades. It took a long time for it to come down to like that target level that we're at. So even
Mm-hmm.
throughout the 80s, I see that throughout the 80s as this period when unemployment was kept higher than it otherwise would have been
Mm-hmm.
to sort of do like labor market repression and like to push those inflation expectations down gradually. And so we're not inflation didn't stay high as long. It's not comparable in that sense, but I do think there's a similar phenomenon where we're trying to wring inflation out, and so you have to hold the labor market back a bit. Um, you can see this sort of in Larry Summers' comments that we're going to have unemployment surge to get inflation
Yeah.
to come down. Now that wasn't true, right? Because we did have labor supply that could increase. And that was sort of helped. But like I do think there is some truth to the idea of when you're trying to bring inflation down, you are going to be holding the labor market back. It just doesn't always manifest as outright decline, outright layoffs. It's just below sort of full capacity. So in the world where we arrived at some sort of soft landing, interest rates can truly be at the neutral rate and normalize. I do think that our true full employment utilization rate is going to be above 80.7.
Oh, interesting. When's the last time we were over 81%? It has to be a long time ago.
Early 2000s.
Early 2000s. Okay.
Yes. I
Yeah.
look at the late 1990s, early 2000s is my
Yeah.
benchmark for what full
Full
employment should
employment
and
is.
could look like. And that's being generous because we're a lot more educated than we were then. And so,
Right.
for structural reasons, you might suspect we can do even better.
Well, I guess consistent with your view is wage growth continues to moderate, at least I think, right? I mean, it feels like it's 3.5 to 4%. It feels like it's still edging lower. So consistent with the idea that there might be a little bit of slack there still in the labor market, and consistent with the idea that Federal Reserve's still trying to get inflation back to target. It's not quite there yet. So yeah, interesting. Let's do one more. Chris, you want to do yours?
Sure. 4.6%.
4.6% in the GDP.
Nope. Came out today.
Oh, income
Say that again, Chris.
Came out today.
So it's
in the income release.
In the income release.
Oh, the saving rate.
Savings
Personal
rate.
saving
The
rate.
personal saving rate.
Adam, who was first, me or Marissa? Just asking.
I think
Come
it was
on, man.
by like a
You got to
second.
rewind the tape. You got to rewind the tape.
You got to be quick on this game. All right, saving rates. Oh, I meant to ask. There was a big jump in personal income, but it looked like it was non-wage income. Is that just cost of living adjustments, that kind of stuff in the January? To Adam's point, that the January data is always a bit squirrely.
Yeah, because the compensation was 0.4 and it was 0.4 last month too. It was proprietor's income, rental income, transfer payment,
Yeah,
big
it's weird
transfer
stuff.
payments,
Yeah.
which should be seasonally adjusted out of there. I don't know. I'm not sure what's going on there, but it looks like a seasonal thing.
Right. Why'd you pick
cost of living? The cost of living increase was 2.5%.
2.5? Right.
Over the year.
Yeah. Chris, why'd you pick that number, the 4.6?
It was a big jump for a percentage point from the month before and highest level since June. And I think it speaks to consumers who are just normalizing savings rates, right? They've been low. They need to get back up to a more appropriate level, right? They need a lot of consumers' households need to replenish the savings that they exhausted. And then on top of that, I do think there's a precautionary element here. So some of this uncertainty is going to translate into consumers, again, just sitting on their hands, and that's going to help savings certainly, but at the cost of more spending, right? So that points to this idea that the economy is going to slow from here, and we can already see some of that data in the some of that effect already in the data here.
Great, good. Let's move forward then. I don't have a statistic. I was too lazy. I don't know. Somehow I missed. Usually I'm very well prepared, but I don't know. Maybe because we were doing so many we did a podcast yesterday. Maybe that's what's going on. But anyway, I'm not prepared, so we're going to move on. But it's good timing anyway. Adam, let's turn to your recent work and maybe give us a little bit of context. You're at the Economic Innovation Group, EIG. Why did you focus in on immigration and immigration policy in your work? Why is that front and center in your research right now?
That's a great question. I think it's an area that more economists should be focused on because there are a few characteristics of high school immigration that make it unique. One is it has direct, high certainty, substantial impacts on innovation and entrepreneurship. If we turn up the dial on high school immigration, you know that in the next year, right, the year and two after that, you're going to see a movement in patenting rates, in entrepreneurship rates, because they're more innovative, they're more entrepreneurial, and there's really and industry impacts too. So you look at like our attempts to catalyze a new semiconductor industry, like they have huge impacts on that. Like Taiwan, TSMC couldn't be doing what they're doing if they weren't allowed to bring in the workers that they have been allowed to their fabs. And so you have these really important things. Normally, if we're like, all right, we want to increase innovation in the United States, that's a hard thing to do, right? It's like, what are we going to do? Cut the corporate tax rate? Like maybe that'll indirectly do it, or like R&D incentives. Like hey, you got to structure them right, and you've got sort of these estimates of how they might work. Maybe eventually in the long run, increase college, changing universities. Like these are hard levers. Entrepreneurship similarly, like getting more entrepreneurship is very difficult. So the literature is very clear that there is substantial, high certainty, really known impacts of these things on these outcomes that we really care about, that are prime drivers of productivity growth. And the other thing that sets it apart is any other policy that you think might work on those things eventually is expensive, right? Like R&D, expanding universities, like there's no free lunch there. High school immigration could raise, we did a fiscal estimate of just expanding H-1Bs and just direct effects, excluding innovation effects and entrepreneurship effects. It's not hard at all to raise $1 trillion over a decade just by expanding skilled worker visas. And so this is a policy in a league of its own. There's nothing else like it that can move these things that we want to move, that are so fundamental to growth and prosperity. And you do it and you make money doing it. Like this is so, it's such a no-brainer, and it's so important. And so that's sort of what brought me to the topic.
Yeah, it makes perfect sense. Something has been bothering me. I haven't looked into it, and I've not seen anyone write about it. But since the pandemic, we've seen a high level, at least from the IRS data that we follow, the EIN data, that tracks the identification numbers of new companies that form, high level of new business formation. Even to this day, it started with the pandemic, and to this day, and last time I looked, it felt broad-based across lots of industries, almost everywhere in the country. The most recent data has been a little weird, more concentrated in a few states, but broad-based. Have you looked at that data? Does that connect back to the immigration story? Because it does correlate with the surge in immigration that we've seen over the past several years. Do you think they're related, or have you looked at that at all? I'm just curious.
Yeah, so I think it's still a bit of a mystery. But I think that there are a few factors that are highly plausible. So one is you had sort of a shift in geography of where people were moving a bit post-pandemic.
Right.
And so like when you see these areas that are seeing growth that haven't really seen a lot of growth before, like my favorite example is like northeastern Pennsylvania is like really seeing a ton of growth, right? People are moving there from New York City. So you have these moves from the urban cores to out of exurban areas and rural areas. And I think that's that's part of the story. I think remote work is part of the story. It's pro entrepreneurship. You know, it's easy to be an entrepreneur. Freelancers have always been more remote than regular workers. So I think that's part of it too. Um, I haven't seen any research on this, but I think house prices probably play a role. There's an older literature showing that rising home prices increase entrepreneurship via the collateral channel, right? Like if you want to start a business, having that collateral is really useful.
The homeowner's equity, you're saying, and the built up in
Yeah,
the house. Yeah.
I
Yeah.
think those are part of it. Immigration possibly as well. It did sort of predate the immigration surge. Like it started pretty early in the pandemic, like surprisingly early. But it could definitely be playing a role. I would say it hasn't really been decomposed into these various channels and maybe some other mysteries.
Yeah, I think that I'd love. I think that'd be a good something to really dig into. I know economists don't like using scatter plots, but we did do a scatter plot comparing the number of businesses that formed relative to the size of the economy on one axis. This is across. I think we did it across counties. I think we did. It was a scatter plot against counties, and on the other axis was immigration. You know, the immigration over the last few years, and it's visual. You can,
Okay.
yeah, obviously, I'm not controlling for lots of stuff, so but it's very suggestive of immigration, having a role here in the high formation rates that we're observing. But let's go back to the study. The one other broad question I had until we start talking about some of the impacts and some of the policy proposals that you have. Why just high skill immigration? Why not all immigration? I mean, my sort of narrative has been, and I'm totally on board with you. I think there is no better way to move the dial on the economy's potential growth rate and also address our long-term fiscal issues. Because if you get a tenth or two more on GDP growth every year, you're going to generate a lot of revenue, and there'll be less spending, and you address your fiscal issues in a very significant way, and that's much easier than raising taxes or cutting spending, as we're figuring out here pretty quickly. So I'm on board, but why just high skill? Why not? Are you saying that there's a well, I'll let you answer the question. Why high skill? Why not all skill levels?
Yeah. So I'm still a big proponent of all kinds of immigration.
You
So
are,
this
okay.
isn't against low skill immigration, but I think there are two reasons: one economic and one sort of public choice.
Mhm.
We ran a survey on immigration. We ran a few of them actually, and before the election, and what we found was that 71% of people who were planning to vote for Trump, this was back in like October, support more high skill immigration. And it's extremely popular. The number is
See,
like
you should
closer
use
to
that
80%.
stat in the game, 71%. Of course,
I
we
didn't
would have
think
never gotten
you
it.
would never have gotten it. Yeah.
We
I
would not
thought
have
about
gotten
it. I
that.
thought about it. But like
Nice.
that it is extremely bipartisan and popular. And it's not just our survey data. Like you can look at anyone who surveyed the public on high skill immigration specifically. And there's two reasons for that. One is that the public really doesn't like illegal immigration. That is not popular, right? And then legal low scale immigration is more mixed. It's in the middle. High scaled is super popular. And so what ends up happening is that especially in DC, you have this idea that, oh, immigration reform has to be comprehensive. It has to be comprehensive. Like this is the way it must be done. But you end up with Republicans and Democrats both have demands about low skill immigration, and they both think that high skill immigration is their bargaining chip. So Republicans will be like, look, we're going to give you amnesty, or we're going to give you high skill immigration, but you have to give us the border. And Democrats will be like, look, we'll give you high skill immigration, but you've got to give us amnesty. And if it's everybody's bargaining chip, it's nobody's bargaining chip. And so it's just low skilled and family based immigration overall is very complicated. There's a lot of uh, moral values issues involved there. And wherever I land on those issues, it's very, very different from a policy that is so clearly self-interested, right? And so that's like the public choice case. The economic argument is that when you talk about the benefit to U.S. workers from low-skilled immigration, you have to talk about complementarities, right? And I think that these are real. Okay. But if you look at like estimates that focus on sort of like these sort of like labor elasticity based estimates, like what are the spillovers of different kinds, you get on the negative side, you get George Borjas, who's like, well, it reduced median wage growth by 0.3%. And the positive side, you get Giovanni Perry, who's like, oh, well, it increased median wage growth by 1%. These are not big numbers either way, right? They do not move the dial very much for the median worker, positive or negative. Just focusing on complementarities and substitutes, that sort of very relative labor supply centric approach doesn't move the dial for the median worker, even though we know that immigrants are on average kind of complements. But if you look at high skill immigration, you have numbers like from over the last few decades, I think from 1990 forward, high skilled immigrants contributed 36% of the innovative output of the US economy. Now, what do you think that did to the median wage, right? Like 36%. And this is an awesome study. They looked at premature deaths of immigrants and inventors, and they looked at patenting, they looked at stock prices. Rebecca Diamond, really awesome recent study, but it's not alone in this. You can look at like estimates from state-based models when the immigration population, high skill immigration population increases by like 1%, patenting increases by like 9%. Like those are things that are going to really substantially move median per capita income. And that's just a totally different economic impact. And so that's one of the things I try to do in my paper is like economists have got to get over this complements substitutes focus when it comes to immigrants, because that's not where the action is. That's not where the benefits come from. That's a small thing. Even if there's truth in it, it's like moving the dial a tiny bit. These other things are like just substantially changing the economy in really positive ways. So it's just, I think for those reasons, you've got it's different economics, it's different politics. They should be considered separate.
You said innovation output. You use that term. How do you measure that? What does that mean, innovation output?
So in their study, they use patents first, and then they use like citation adjusted patents, and then they take this approach where they look at like the impact of patenting on stock market values. And so that's how they kind of translate firms have a patent, moves the stock market, and you can sort of apply that to the private sector or private markets as well, and you sort of scale it up.
Right, got it.
But it's true even if holding economic values, it's true even if you just look at like simpler things like patenting counts, citation adjusted patenting counts. It's like a third. It's like a really, really big number.
Well, the most intuitive thing for me is just go take a look at the senior management of the Magnificent Seven, and take a look at where they're from. I think they're almost all of them are immigrants. I think all except for maybe Apple and Tim Cook, right? I mean, let's turn to the policy proposals. And right now, correct me if I'm wrong, but the principal way we bring skilled labor into the country is through the H-1B program. But you've got some views about that program and some proposals on how to improve that. Do you want to go through that? I think the listeners would be very interested in that.
Yeah, I think that what we really need to do, and this is the other big point of the paper, was to don't look for like a little tiny tweak or fix. Don't look for something that like sounds great. Like politicians love to say, let's staple green cards to diplomas. And like, that's not, I take it, right? If that's what's on the table, I'll take it. But like, that is so far from ideal immigration policy. So like, I start with a rethink of the economics. Why do high school immigration really matter? How does it actually work? And then like, okay, design policy based on that. And reforming H-1B is a big part of that. So obviously it needs to be bigger, right? Like it's just, the number was set, in the 90s. It hasn't grown since. You have, it's way more applicants than you have H-1Bs handed out every year. It's oversubscribed, and like the benefits of these workers are huge. And so like the idea that we need to be like carefully constraining this, it doesn't make sense. It should be much bigger, but we should also, instead of doing it by lottery, we should do it by something like age adjusted wages, right? Someone should have to have a real job offer. You make an adjustment for how old they are, right? Because like a 50-year-old who makes $200,000 a year is not as impressive as a 25-year-old who makes $200,000 a year. Their lifetime incomes are going to be different, right? And so you make a small adjustment for age, and then you just use wages, and that's how we should ration them out. We should give them to the people who are making the most money. So you do that, and then there's other reforms that are really important as well. Like we need to change, we need to make green cards to be more automatic, uncap them, make them merit based, right? Like if you're earning a high level, you should sort of be able to be automatically get a green card, get rid of the country specific caps. And then we need to reform student visas as well. And the whole system needs to be changed and smooth and supportive.
You had a catchy way of describing that visa. Maybe you mentioned it and I missed because I was a bit distracted. What do you call these visas?
The skilled worker visa. So
Oh,
we
okay.
think
It's
just
not
kind
as
of
snappy as I thought it was. You need a
replace the
better
H1.
one.
Well, it's snappier than H1B, I think. We've cleared
Snappier
that
than
bar.
H1B, right? Yeah, snappier
Yeah.
than
So
H1B.
oh, maybe you're thinking of EBX. That's our green card. That's the snappier
Oh,
one.
that's what it is. Yeah. Yeah.
Yeah, EBX is our uncapped income-based green card. If you're making over like 75, 85% percentile of earnings, you're doing it for 6 years, you can self-sponsor yourself for a green card. All this fake stuff about like prove your employer needs to prove they couldn't hire someone, it's absurd. It's absurd and it's fake, and also it comes from these myths about how immigration works. This is the problem. When economists say, well, immigration do jobs someone else wouldn't do, that may be a convenient rhetorical advice. But then people go try to write policy based on that assumption. They say, great, all you got to prove is that a native couldn't do the job.
Yeah.
Right.
You also have a visa called a Heartland visa. Did you want to describe that?
Yeah, this is our place-based visa proposal. So the idea is that if counties are sort of demographically declining, they've got falling population, falling prime population, and their house prices are relatively low, then they can opt in, right? Like the local government can opt in to the Heartland visa, and then it's a skilled worker visa. So the skilled workers have to come and live in the Heartland visa, but it's sort of like the skilled worker visa, but it just geographically restricts where they can live. I mean, the we've got such a divergence in economic geography of struggling places in the most successful sort of coastal cities. And part of it is due to where skilled immigrants live. The most innovative, skilled people want to live in those places. And so this is a chance to give other parts of the country an ability to lure marginal, more immigrants into their area. And I think it could be important for development there.
Yeah, it just seems so intuitive and obvious. And, as you mentioned, politically, both sides kind of agree, right? I mean, what could be wrong with bringing the best and the brightest from the rest of the world here and keeping them here? And because they're going to create jobs and wealth and drive the train. And, you can see it across the globe. Just go look across the globe, look at different countries and their immigration policy. Those countries that have immigrants compared to those that don't have immigrants coming in the country, there are two different stories going on here in the world. And this is going to be, this demographic fact is going to become even more obvious going forward, given the declining in fertility rates around the world. I was just reading about South Korean fertility rates. They're through the floor. I mean, that country is going to evaporate, and unless something changes, unless there's they can address it through something like immigration policy. So it just seems so obvious and so obvious. So what's wrong? I mean, is there something in your proposals that people object to or have take umbrage with, or say that's not going to work for some reason? Is there something that you want to point out that people put forward that suggests this just isn't going to work or it's a bad idea?
I don't think there's any I really think it's such a strong idea. There's not really any empirical or realistic argument against the positive impacts. It all comes down to politics. And I have the hardest time in the world convincing people of the polling stuff. People just don't believe it. They think, Donald Trump won the election, and it's a time for reducing immigration, and the voters have spoken. They don't want immigrants. People on the left believe this too, and they're like, it's just not the time for this. This is you've got to be. We've got to do what the populists are kind of asking here, and I try to tell these people high skilled immigration is populist. People want it. They do. I really think a lot of people have the wrong mental model of immigration opposition. I think they think if people oppose immigrants, they are racist and xenophobic, and therefore it's unconditional, right? They just oppose immigration. That's what Trump ran on. Opposing immigration, it applies evenly. But people really, even in older, public science literature on this, show that people, they don't oppose immigrants. They sort of stereotype immigrants and then oppose them based on those stereotypes.
Mm.
So if you tell people there are two immigrants, one from Mexico and one from Germany, and you sort of describe their economic characteristics and they're equal, people don't have a preference for one over the other generally. They see them as being relatively equal, right? And that's kind of where you'd expect like racist based explanations to show up or xenophobic based explanations to show up. But then if you just say, well, would you prefer a German or a Mexican immigrant? Then you see this difference. And the difference emerges because of negative stereotypes about how these immigrants are different. Right. And so it's not racism, right? But it's different. It's a different kind of opposition. And so when you tell people we are going to have a policy here that's focused on high skilled people and it's only going to land in high skilled people, even people who are otherwise negative about immigrants because they're stereotyping them, who otherwise are very concerned about the border or whatever, a lot of those people say, yeah, great, we want high skilled people, we want them of all stripes. So I think it's people aren't getting into the heads of immigration opposition. They're sort of like really crudely interpreting this populist movement incorrectly.
Well, it seems like ironically, the best person to push this policy forward would be President Trump, right? It's kind of Nixon going to China, like
Yes.
he's got the cred here in terms of anti-immigration. So if he says, "Look, I've got the border under control. Let's get the best and the brightest," and I've heard that him kind of say that in the past.
Oh yeah,
something to those effects.
He wants a big beautiful door, right? He wants to
Yeah,
close
there
the
you go,
border,
big beautiful.
close
Yeah.
the border, but put a big beautiful door in there. He said plenty of. What's interesting
Exactly.
is he actually, in his recent description of H-1B visas, not only was he positive about them, but he
Yeah.
actually got the economics of it right in a kind of a nuanced way.
Oh,
He said, look, you let the skilled workers in, and not only, are they doing a job here, but then the business expands and then they hire other people and that sort of takes care of everyone else. So it's like he that's a very nuanced
yeah,
understanding of
yeah,
immigration.
yeah.
It's not a fixed pie. It's and so I think he does get that. And there are a lot of tech people in his orbit that get it, but we'll
Yep.
see what
We'll
happens
see.
there. You have to acknowledge also that in the previous his previous term, he didn't do anything about it. If anything, he sort
No,
of restricted high skill immigration and didn't help there. So I think
no,
part of him gets it, but there's people in his administration who are also not pro
opposed.
high skill immigration.
Yeah, I will say though that I totally agree with you. This is it's so obvious. It's so obvious. And when it's so obvious, it's going to happen. It's just a matter of time. You're just going to get a political window at some point in time. Maybe it's after the border is completely. You have to control the border. You have to nail that thing down so that that's not what people focus on when they think immigration. If that goes away as an issue in people's minds, then this becomes much more viable. And then in the context of our own demographics, I mean, our own native-born population it's going to go negative here, in terms of working age population. Just that's inexorable. That's going to happen. And the pressure on businesses is going to intensify. And then I would think the political opposition from the general population will become, will evaporate as well, because there'll be, there won't be issues with regard to jobs and wages. There'll be a tight labor market and we get a window. But, and I keep going back to our fiscal situation. We're here battling over things like cutting Medicaid or, trying to cut taxes for businesses. If we really want to address our fiscal situation in a way that is politically viable and really move the dial in a reasonable amount of time, it's allowing from our high skilled immigrants into the country. There's no other better solution than that in my view. So I think you're just dead on. I did want to end the conversation about going around the table and seeing what people's probability of recession are. We haven't done that in a while in the context of the recent data. But before I do that, maybe Chris and Marissa, I'll turn back to you. Anything you want to push back on, or you can see I'm a proselytizer here on this issue. I totally agree with Adam on this. Any pushback on this, or anything you want to call out? I'll go to you, Chris, first.
As an immigrant myself, I'm all for it. So, there's no,
And the skilled one at
no
that.
opposition. No opposition here.
No opposition there. Marissa?
Just a question, Adam, about the Heartland visa, right? Is there enough supply of jobs? You know, is there demand for high skilled labor in some of these non-coastal Midwestern, middle of the country areas? Is it a chicken and egg kind of thing that this happens? Or can you explain a little bit more about that, the regional placement of immigrants, high skilled immigrants?
Yeah, so I don't see the pie as kind of being fixed, and I think that if there's one thing that sort of creates its own demand, it's human capital. And as you let in more skilled immigrants, that sort of increases opportunities for businesses to invest in those places. Let me give you a concrete example. So if we fix the H-1B system so that's no longer done by lottery, the industry that's going to be really hurt by this is the IT consulting industry, right? Infosys, Tata, all those guys. They really depend on the lottery. They're like the lowest paying H-1B employers. One thing that I think would happen is like you fix the H-1B, that is an industry that now can relocate to, they don't have to go away, they just relocate to Heartland visa areas. And so like if you are looking at Buffalo, for example, as an employer, and you say, do I put my next office in Chicago or do I put it in Buffalo? Well, if I put it in Buffalo, I have a really easy, readily available supply to skilled workers from all over the world. That changes how you think about that place. And so I think like the Tatas and the Infosys of the world will be really, probably first movers at that, but there's tons of other opportunities as well. The other thing to know about is it would be both of our skilled visas and our H-1B fix, or our skilled visas and our Heartland visas would allow them to work as entrepreneurs. And right now it's very difficult to come here on an H-1B and do any sort of entrepreneurial activity. So immigrants are very entrepreneurial. They create their own opportunity. And so allowing them to work in that way, I think will help increase the demand for work in those areas.
Okay, well, great study. We'll post it to the notes to the podcast. And I know you also have done a lot of work in the housing area, but we're gonna have you back to talk about that because I didn't know that. You sent me the link and I was just perusing it. Some really interesting ideas. And there's a big link between immigration and housing, so might want to talk about that. But let's end the conversation back to the economy, given all the things that are going on, and kind of the way we've been encapsulating our kind of general thinking about things is what is the probability the economy is going to enter into a recession at some point in the next 12 months? Let's say 2025 going into 2026. And I'll just go around the table and begin with you, Marissa. What's the probability of recession in the next 12 months?
A third.
A third. That's up. Where you were.
Well, you asked this. I forget when the last time we did this was. It was
a couple of weeks ago, not too long ago.
And I think I was at like 30.
30?
I think
So yeah,
higher.
it's going up.
The third. Okay. Okay. Chris?
I'm at a third.
A third? In you were also at 30, I think.
I was at 38. Yeah. So just bump it up a
little. What was your low, Marissa, in the cycle? What was your low?
I really
think
need
you were
to
15.
No, I don't think I ever
You
was
never
at
got to
15.
15?
I think maybe I was down to like 20.
Yeah. Okay. 15 being kind of the unconditional probability.
You were at 15 recently.
Yeah, I was at 15. That was I was at that low. Yeah. Chris, what was your low? You're always a bear.
25.
25. Yeah, 25. Adam, I'm putting you on the spot. I know you don't do this for a living, but do you have a view? Can you encapsulate it in the probability of recession?
Yeah, I'll put it at 20.
20.
I think we have to be, I agree with Marissa on the fragility of the economy, but I don't see the correction, I don't see like an economy that's growing below potential and being restricted by policy as necessarily one that tips into recession. I would point to 2018 as a time when Trump was going wild on his trade war, right? the Fed had raised interest rates too high. You remember they had to cut them because
Yeah.
they were wrong about where the neutral rate was, and they were discovering that. Um, Uncertainty was high, and you could see the economy slowing. You could just see the housing market just like take a breather, right? And job growth slowed, but we never went into a recession. It was all of the things that are happening now, including the restrictive monetary policy. They were all present, and we didn't end up in a recession. So I don't think it's necessarily the case that even if you think all of these bad things kind of manifest, that it pushes us into a recession. So
Just
I'm
food for,
still at 20%.
just a food for thought, Adam, on your point about the President Trump's first term. We don't know what the counterfactual is. I mean, if there had not been a pandemic, I think there was a pretty good probability we'd go into recession.
Oh,
Pretty
I'm
good probability.
total other side of that. If there had not been a
Yeah.
pandemic, we would have seen positive effects from a full employment economy that people did not think. I think the productivity growth would have been really strong. Um, I believe in the Verdun's law story of full employment and productivity growth. I think we were heading to a really great place.
Well,
Of course, he could always do it, right? He could always choose to push us into a recession. So, you're to a certain extent forecasting his behaviors. But I
no,
think
I
that
think the die was cast. I think the die was cast. I mean, remember the yield curve inverted in,
oh,
yeah.
because the Fed was lowering rate. Mark, that was
Like,
because the Fed was making a mistake. The Fed was making a mistake. Don't you remember
this
my
is what
Moody's
I
paper?
miss when he left us, and now I don't get these kind of arguments anymore. Hey, but let me ask
So
one more question about the yield curve. Obviously, the yield curve this last go around, inverted, and we didn't get recession. Here we're back around again. The curve inverted. I think, is it still inverted, Chris? I don't know.
Yeah, but it's
It's
it
small. I
justifies
know it's small in the grand scheme of
small.
things.
Yeah,
Yeah.
but yeah,
Did
it's
we
like
put more weight on the curve as a recession indicator this go around than we did a couple 3 years ago? I mean, I never bought into that, and I argued against it and didn't think we were going to have a recession. And I'm still not arguing for a recession now. But by the way, I'm at 30%. I think there's a 30% probability, and I'm up. I
you're
was
up.
as low as 15. But I think the uncertainty is palpable, and we Adam, go listen to that podcast from yesterday with the fellow from Breitbart. The one thing I took away from that was that President Trump is not going to be as sensitive to the economy and the stock market as he has historically. He's committed to these policies. And if you're committed to broad-based tariffs, I don't know. This feels like the prescription for a problem.
I like John Carney a lot. John's a nice guy, but he tends to think that his view of the world is Trump's view of the world. A lot of people want to believe that Trump's view of the world is their view of the world.
Okay.
That he's embraced
Fair enough.
they have this esoteric theory, and no, Trump has the same sort of esoteric theory
Yeah.
of how things work. I don't think that's the case.
Okay. Okay. We're going to have to call this a podcast. But there's a lot to talk about, and we'll schedule the next conversation, Adam, if you're up for it, and we'll
Absolutely.
go deep on housing. By the way, do you have any views on Fannie Mae and Freddie Mac? Just asking real quick.
No, I don't. No,
Damn, that would be
that's
fun
for you,
too.
Mark. I leave that one. If I had that question, I would ask you.
That would be fun
You
too.
should get some.
We should get some for the next conversation. Yeah. Yeah. Anyway, thanks so much, Adam. It was really always a pleasure. I, very much enjoy your insight and great conversation.
Thanks for having me. Always glad to be here. Happy to come back anytime.
Great. And dear listener, hopefully you enjoyed that. And we're going to call this a podcast. Take care now.